We're still recovering from that, and we're still obviously losing money on streaming, and obviously that's one of the reasons why we have to turn that around. But as we said on the call yesterday, we're going to get to a point where we're going to recommend to the board a dividend at the end of the year. That suggests some confidence in our cash flow directory and how we not only generate capital, but how we allocate capital.
Barton Crockett of Rosenblatt Securities just upped his price target on Disney to $129 from $120 and reiterated a buy rating. He joins us now. Barton, I guess, first off, your read on the market action today. Is there a rethink of the reorganization, of the strategy that was laid out by Bob Iger, or do you feel as if, the stock's just up a lot, in the past couple of months and it's given some back?
Well, I think there's part of that. I don't know if there's people who follow on with Nelson Peltz when he's moving in. And then now that he's no longer activist, maybe some people are selling around that. That would be speculation. I do think that, as your previous guest was saying, there is a lot of kind of concern, I think, broadly around the market. So, I think the market's not helping Disney here either.
And then when it comes to Disney specifically and the plans that were laid out, the magnitude of cost savings that are going to be targeted and things like that, where does that get you? I mean, 129 as an upside target certainly is well below where this thing traded the past couple of years. Do you feel there's some valuation headwinds at this point?
Well, I think that you're just taking this company and rebuilding it from the ground up. So the good thing about Disney relative to the other media conglomerates is that they have theme parks, and their theme parks are a huge contributor, doing great. That's something they have that the other media companies don't. They are, like the other media companies, going through this process of acceptance of pay TV as a business that's in decline in perpetuity, and hopefulness that the direct-to-consumer streaming can offset that. That's going to be a tough road. I think that what we see here is that the cost cuts are necessary to rebalance those two. I think they can pull it off. But there's clearly going to be a lot of wood to chop to balance the expenses relative to the normalized revenues. And it's a business that's in transition. So I think there's some question about where it settles out. So I think it'll work, but I don't want to get over my skis.
And on the streaming side of things, is there risk in terms of cutting content spend too much? I know everybody in the industry pretty much is trying to cut back, but I just wonder if we know the right level or the sufficient level to keep subscribership strong.
Look, no doubt they have some numbers that will tell them that their franchises work. And if they lean in on those and cut back on some of the less franchise kind of general entertainment, that there's a decent trade in terms of engagement. Do we know exactly how much you need to spend to be competitive? No. Is this a great setup for Netflix, with all the competitors pulling back? Yes. But you need to right size. This is the moment where we need to grow up. We need to make money in these businesses. So what Disney's doing is the right decision. And we're going to have to count on them to manage the revenue and the expenses to an equilibrium that makes sense. And I'm glad they're moving in that direction now with the cost cuts.
Yeah, as they also cease disclosing subscribership trends, maybe that's going to take a little bit of the pressure off on that front. Barton, thanks a lot. Thanks for checking in on Disney today.